So far in this topic we've been focusing on debt markets, and in particular short-term and long-term debt markets, and more importantly the distinction between short and long-term interest rates. So we're going to be following on with that theme in this particular presentation and looking at short and long-term interest rates and how they move over time. So in the first chart here I've got the US federal funds rate and the 10-year Treasury interest rate over time from 1982 through to about 2010. Now, first of all, you can see that broadly speaking they do follow the same trend. They're both trending downwards over this particular period, and you can see, for example, in the mid-1980s both the short and long-term interest rate did actually decline, but then in the late 1980s they kind of rose together as well. The dark line down here is the federal funds rate. That is the overnight interest rate. It's the US version of Australia's cash rate. And the dotted line here is the 10-year Treasury yield, or the 10-year bond yield. So we've got a 24-hour interest rate and a 10-year interest rate. Now, in this particular diagram, there's a column here at about 1991 that was a recession in the United States, and you can see after that recession both the short and long-term interest rate declined. There's another column here, 2001, that was another recession caused by the dot-com bubble bursting in the US stock market, as well as the 9/11 attacks in the US. And then in 2008 there's another column. The width of that column suggests a more severe, longer-lasting recession than the previous two, and that was a result of the global financial crisis. So what you can see here is that the policy interest rate, the 24-hour interest rate, was cut after each of those recessions. And that was really the government's attempt, or the central bank's attempt, to try to stimulate spending once those recessions had taken hold of the economy. Another interesting thing, however, is that, or really the lack of high-level correlation between the short-term interest rate and the long-term interest rate. What I mean by that is, after the recession in the United States in 2001, the policy interest rate, the federal funds rate, was cut to around about, or just over 1% down here in 2004. So very aggressive cutting from around about 6.75% all the way down to 1 to 2% over this period here. What did the 10-year interest rate do? Well, the 10-year interest rate remained stubbornly high. The 10-year interest rate over this period, the short-term interest rate was very, very low. The 10-year interest rate seemed to average around 4–4.5%. So even though the central bank could aggressively cut the 24-hour interest rate, it was unable to significantly reduce the 10-year interest rate. Now, why is this the case? Well, first of all, the 10-year interest rate sets itself at the average of the short-term interest rate over the next 10 years. What I mean by that is the 10-year interest rate is almost looking forward and trying to anticipate what short-term interest rates are going to be over the next 10 years, and the 10-year interest rate sets itself at the average expected level of these short-term interest rates. So the 10-year interest rate over this period in 2003-2004, by being at 4–4.5%, it was literally saying to itself, well, we know that the short-term interest rate is down around 1–1.5–2% today, but over the next 10 years we expect this interest rate to come up, the short-term interest rate to come back up to around 4% and average close to 4% over the next 10 years. Now that's really the expectations hypothesis that is controlling, in a way, that 10-year interest rate. So why is this important? Well, it's actually very important because it hints at the inability of monetary policy to be as effective as it was previously. When the economy gets into trouble, the government wants to lower interest rates to try to stimulate spending. The government can lower the 24-hour interest rate as low as it wants to. It could have pushed that interest rate down to zero if it had have wanted to. But with a 10-year interest rate, that interest rate is going to be driven by largely global forces. It will be driven by the expectations hypothesis, that is, when the short-term interest rate falls, it will drag the long-term interest rate down a little bit as well, particularly if the market thinks that this short-term interest rate is going to be low for a very long period of time. Then the 10-year interest rate will come down quite substantially. But this 10-year interest rate is also going to be driven by interest rates in other large financial centres of the world. So because it is being driven by interest rates in other large financial centres of the world, the Federal Reserve just simply cannot push this 10-year interest rate down to the level that the short-term interest rates were at over this period. So that's why the 10-year interest rate is stubbornly high. Why is it important? Well, it's important because short-term interest rates, as we'll see later on in this course, short-term interest rates influence interest rates on mortgages, personal loans, car loans, student loans. But these long-term interest rates, they are the interest rates that determine the amount of investment spending in the economy. So, for example, if BHP wants to undertake a significant expansion of one of its mines, then typically it will borrow large amounts of money in the bond market. And so that is true for most companies. Most companies undertaking a substantially large investments will want to lock that money that they borrow to pay for that investment away for a long period of time. So they need to go into the bond market and borrow money for 5, 7, 10 years to finance that big investment that they're thinking about undertaking. So while short-term interest rates, as we'll see later on in the course, do influence mortgage interest rates and personal loan interest rates and those sort of consumer type lending products, big investment spending is financed and therefore driven more by these long-term interest rates. So just after 2001, when the American economy was struggling, the Federal Reserve simply could not push the 10-year interest rate down any further than around about 4.5%. It was beyond the control of the Federal Reserve. The 10-year interest rate was beyond the control of the Federal Reserve. So by not having the ability to push this 10-year interest rate down to very low levels, it means that the Federal Reserve had a limited ability to be able to stimulate, through lower interest rates, the big investment spending type projects that I was talking about previously. So looking at this graph, quick summary: short-term interest rates influence to a large extent mortgage interest rates, personal loan interest rates, car loan interest rates, whereas big investment spending is driven by these bond interest rates. And these bond interest rates simply are beyond the control of central banks these days. Now, this is a quote from Alan Greenspan, which really reinforces what I've just said. So I'll give you time to read that. But one thing it does say, probably the most important sentence of this paragraph, is the second one. Long-term real interest rates have significantly more impact on the core of economic activity than the individual actions of nations. So that's really saying that it is long-term interest rates today that really do determine most of the borrowing and spending that takes place in the economy. And those long-term interest rates are driven by global forces. To a large extent, they're beyond control of the central bank. This is a related quote. It just talks about how the global bond market is $100 trillion in size. It's actually bigger than that these days. I think it's closer to about $130 trillion. So it's a huge market. And just by thinking about a global bond market which is over $100 trillion in size should give you some insights into why it's very difficult for central banks to actually influence the interest rates on bonds. Now, more recently we've seen quantitative easing being used to lower interest rates on government bonds, and we'll be talking about that more and more as we proceed through this course. However, quantitative easing is quite a radical, unconventional monetary policy. So true, we can use quantitative easing to push down long-term interest rates on bonds. However, it is a very dangerous thing to do. So it's really the last resort in terms of monetary policy. So apart from QE, these quotes are certainly true. So I suppose one way of thinking about this is, apart from QE, which is quite an unconventional monetary policy, quite dangerous because we really don't know the long-term effects of QE at this stage. Apart from QE, central banks have very limited ability to control long-term interest rates in a safe way. More about long-term interest rates. What I'm talking about here is that governments can control short-term interest rates, but they really can't control long-term interest rates, and long-term interest rates are beyond control of the national government, so we've really covered that. And then in this slide I'm talking about the global savings glut. So the global savings glut is an explanation of why interest rates declined in the 1990s and 2000s, and it's worthwhile taking a little bit of time to do a bit of search on the global savings glut and read up about it, because it is related to the interest rate changes and interest rate movements that we've been talking about in this topic so far. So have a look at the global savings glut. What I've got here is 10-year government bond yields. Now, ignoring Japan, if we just focus on the United States and Germany, we can see the high degree of correlation in 10-year interest rates across those two economies. So why are those interest rates so highly correlated between the United States and Germany? Simply because of international capital mobility. That is, if these interest rates, these 10-year interest rates in the US and Germany get too far out of line, money will actually move between the markets to bring those interest rates back together. So for example, if interest rates in the United States rise significantly higher than in Germany, money will move from the German bond market into the US bond market, and as that money moves from Germany to the United States, because the interest rates in the United States are higher, that will actually push bond prices up in the United States and push bond interest rates down. So looking at this, although long-term interest rates among countries are highly correlated, Japan being the exception because over this period Japan was in a very deep recession, short-term interest rates can and do move in opposite directions across countries, as we can see here. So these are the policy interest rates of these countries, the 24-hour interest rates, the interest rates controlled by the central banks of these countries. And we can see that not only do these interest rates move independently, but large gaps can open up as well. So the interest rate differential between Switzerland and New Zealand in around about 2006 looks to be around about 6%, 6.5%. So big gaps between interest rates can open up. That's not the case for long-term interest rates. Now the reason these gaps can open up for policy interest rates or short-term interest rates is because these interest rates are controlled by the central bank, and the central bank can open these interest rate gaps up as large as they want them. Okay, what we've got here is the 2, 5 and 10-year bond yield for Australia from around about 2005 through to 2013. You can see the sharp reduction in bond interest rates in 2008 going into 2009 when the global financial crisis hit. Now, a big part of the reason that interest rates on bonds dropped, now remember these interest rates are beyond the control of the government. It's not the central bank which are pushing these interest rates down. It's another force. The central bank can't push these interest rates down unless they implement QE, and QE wasn't being implemented in Australia at this time. So it's not QE, and it's not any direct ability of the government to control interest rates, which pushed interest rates down from around about 7.2% down to sort of 3 to 4% during the global financial crisis. It was really the fact that money was moving out of the Australian stock market and into the bond market for safety. people were selling their stocks and moving their money into the relatively safe bond market. That was pushing bond prices up over this period, which pushes interest rates down. What I'm showing you these series for, Howard, these interest rate series, is to show the high degree of correlation over time across 2, 5 and 10-year bond interest rates. If, however, we put the cash rate in, so I've taken the 2-year interest rate out and I've put the cash rate in, you can see that, very broadly speaking, there is some degree of correlation between the short-term cash rate and the 5 and 10-year long-term interest rates. But really, those interest rates are just following the economic cycle. It's not as if fundamentally they're related in some way. That is the cash rate and the 5 and 10-year interest rate. So for example, you can see the cash rate around about February, March 2009, the cash rate was falling, and then it spent quite a bit of time at 3%. However, while the cash rate was falling and then sitting at 3%, bond interest rates were actually rising, and a big gap was opening up. This is really just highlighting the fact that these short and long-term interest rates are effectively disconnected, if you like. There isn't a lot of correlation between them over short periods of time. They can move in opposite directions. Most importantly, they're driven by different forces. The cash rate is driven by the central bank's monetary policy. Long-term interest rates are driven by movement of money in and out of the bond market, which changes prices, which changes yields. And also global forces act on these long-term interest rates as well.